Good evening, ladies, gentlemen. I got a fascinating conversation this evening that I want to dive down into when it comes to, again, reiterating, does value matter? I mean, that's the real question, but value is only, is only a metric that can be understood if we understand where we're going in the future, because there's nothing wrong with expensive metrics if the future is as bright as we hope it's going to be. But we're not only going to talk about that with my Canadian dividend stocks, do some comparables that I think are just truly mind-blowing, but I want to talk about the variety of stuff going on in the markets today, or basically coming up in the week. But we have the Blossom event coming up too. I know you guys are big on Blossom. Maybe we'll talk a little bit about that as well. So if you're on a path to financial independence, you damn well want to retire early, join me on these Saturday or Sunday night live streams, getting a little delulu here on a weekend, Sunday night, getting ready for work. Consider subscribing, join me on your journey, and let's keep the ball rolling. I want to kick this off by talking about this fun clip that I just saw with Aiden Ross. This guy's like a 24-year-old guy's like on his way to becoming a billionaire, but he just made an iterated point in this little conversation that I just thought was funny, that I was just touting that, with stocks flying to highs that we haven't seen in quite some time. It's a little bit of good golden advice in here that I've been, just loving.
It's easy to make a lot of money. It's hard to keep a lot of money.
I agree.
How are you making your money work for you?
I've invested heavily into the crypto market, which is, by the way, that's another thing I'm going to talk about. But I've invested in crypto, real estate, watches. Cars are a horrible investment. Doesn't count, obviously, unless it's Porsche. But yeah, I would say stocks, real estate, crypto. My story with crypto is you never want to hold too long in a market, right? Like, don't get greedy. That's one thing I did learn this year. Take your profits when you're up. Don't get greedy and go for like a 10x. If you were happy with a 1.5x or a 2x, take it. Don't get greedy. The market's always going to be up and down. It's a game. You always want cash ready when the market's ready to drop. So I think not making that mistake is something I want to be heavily about. Sorry, what was that?
I love that so much, because I'm like, this 24-year-old is just like, when you do good, you've doubled, tripled your money. Why hold out for a 10 bagger when the future, is so volatile? And I have flashbacks to like 2022 and just like watching like just the calamity of SPACs collapse. I don't know if you guys watch Ben Felix, a good channel that I'd recommend. Like he really iterated very well the risk with individual stocks. And I don't want to be too hypocritical in this video as we talk more about ETFs today, but as a guy that's made most of his money off small caps, I'm a guy that literally takes profit, man. I've never really held on to anything I've made a material amount of money on. I would probably hold on longer if the businesses actually perform, but the problem is that expectation and that hype that comes with massive stock fluctuations to the upside. The businesses usually can't even come close to keeping up with that momentum because the market's a drama queen, right? I mean, we were just talking about this with one-on-ones with some people that watch my channel, and just talking about like Canopy and people catching these boom cycles, but don't realize that, they didn't materialize and they never got out and kind of got hit pretty hard. But I'm bringing this up because I'm not telling people to exit the market by any means. I'm just saying, hey, if you're up on a lot of individual stocks, we're in a very FOMO market, take profits, diversify it, put it into some broader market ETFs for the long run. But even in that statement, I'm shocked at just by like the valuations in the total market. The world market ETFs, their valuations are very similar to what the Canadian markets are going through. The US markets, again, I know it's treated as like the holy grail of investing, but I still think the valuations can be semi-just in the US markets with the growth rates that we're seeing. We'll take a look at that. But for the Canadian markets to be trading at a relative 21 times multiple, and again, I was iterating this chart, I just find it so interesting when you look deeper into it, to see the price to earnings to where they are today, where the only time they've ever been this high was comparably the .com area. And this is coming off the back of the 2022 lows, where we hit lows we didn't really see since, the pandemic or the 2008 financial crisis. So the pendulum swing in the last 5 years from stock fluctuations to valuations, they're just insane. And I mean, we're still sitting in a market, especially in the US, where they haven't cut interest rates. There's still record levels of money in money market funds. And I have no idea what any of this means. Is this the start of a new .com era like bubble? Is this just the market awakening to AI and margin increasing and market efficiency? I have absolutely no idea. But if we do scroll down, they do give an idea of Canada versus the rest of the world. And in the total market, index funds right now are trading at like a 20 times multiple. Again, multiples that never existed prior to the .com bubble. And all these multiples only just came into play within the last couple of years. I just find that just marveling in it is just, it's just a peculiar happenstance. I don't know what drove this to these levels, and I'd love to get your guys' opinion on it. But I just want to show you something that I find really interesting about obviously the ETFs that I hold, because I really only hold 3 global market funds, VDY, S&P 500. This is about as boring as it gets for me, and I'm very happy. These are like my 3 ride or die ETFs, I'm going to call them. for the time being. XCQT relatively new. We'll see how much we can build that out in the coming years. But for right now, let's just talk about the Canadian markets with VDY. And I want to compare it to VCE, because VCE to me is the same thing as VOO. It's just the Canadian equivalent. And I'm going to compare kind of the underlying aspects of this ETF to VDY. And this should iterate why I love VDY so much. Because I never really liked the broad-based Canadian ETFs because I hated the exposure. And this was long before the 2022 crash, but I hated the exposure to Shopify. I always just felt like Canadian tech companies were always bubbles. I just didn't like lots of aspects of the Canadian economy that sit really upper weighted in the Canadian ETFs. So I just never liked owning them. And there were so few stocks. I was always more on the idea of hand selecting them, but that was until I fell in love. I found my true love in the Canadian markets being VDY. So this is VCE, right? And I just want to really iterate the underlying fundamentals that there's only 49 stocks in this ETF. The median market cap is about 90 billion, we'll say. Price to earnings multiple right now on this ETF is 19.8 times. The price to book is 2.3. The return on equity is 11.9, but the earnings growth rate, which I really want you to pay attention to here, is 7%. So you're paying almost a 20 times multiple for an earnings growth rate of 7%. Just to put that in perspective to the U.S. markets, the U.S. markets have an earnings growth rate of 22%, but traded a multiple of 27 times. So I'm like, even the valuations right now on these look pretty bold. And again, that is just having to do with the upper weightings and a lot of tech companies that are flying right now. I mean, the banks are even trading at higher multiples, as discussed, that we haven't seen in a very long time. But how does this compare to VDY, maybe? I mean, we're talking about a number of stocks of 58. So we already have more stocks in VDY than we do VCE. The median market cap, almost 90 billion. Wow, look at that. Almost the exact same. The price to earnings, though, is 14.5 times. The price to earnings multiple is almost 6 points less. And then if you look at the return on equity, 11.9, and the earnings growth rate is 6.6. So we're getting a 0.4% lower growth rate. But that is it's these stocks, these dividend stocks in Canada are just so materially cheaper. So when you look at just the dividend stocks, or basically a dividend equated ETF versus just a broad-based Canadian ETF, it is wild looking at the valuation difference. And again, I think there could be a few things resolving into this as well when it comes to the precious metal market. That's obviously in here as well. Those valuations have gone up quite materially. So there's a lot that could be, chiming toward why the Canadian markets are very expensive. But still, I'm just so much more on board, taking a slightly lower growth rate. I mean, from 7%, to 6.6% on average here, to not be getting that risk, in my opinion, is just kind of interesting to me. Again, you can take it or leave it for what your thoughts are on the future of the Canadian economy and the stocks that are exposed, but most of the overlap are very similar in these two ETFs, with the exception of some of the technology companies, right? And if you know VDY, you know why I'm in it. And we're going to answer some of your questions and comments around it, because so many of you guys were asking me about the dividends and stuff like that. But overall, I like these ETFs, and I like stocks like Google and things that can bring down the overall valuation. Because at the end of the day, I'm more or less a value guy. I love stories. I love getting an idea of the future. I think the values in the future, I don't mind paying a hefty premium for a stock if I think the future is coming and the future is there for it. We talked about this with Take-Two Interactive. I can look at a lot of stocks and say they're very expensive now, but if you believe in what's coming in the near term, then the valuation might not look so extreme, right? And these are stocks like Google to me. I love finding things that I can understand today. I don't know if it's going to work out, but I'm very excited for earnings that are coming up with Google. At a 20 times multiple right now, it's the cheapest S&P top 10 company that has the same growth rate as pretty much all the other tech companies performing. Obviously, NVIDIA is an exception here, and Tesla's a complete, no growth right now. But still, Google's this nice happy in between for me. So we'll see if it works out, what earnings can bring for it. I'm hoping by the end of August that I can take some profit on Google once we get through the court cases and it can actualize its real underlying fundamental value. But again, the whole reason I'm doing a lot of this, guys, is I'm just trying to build my legacy portfolio. And I'm in the latter half of this where we're getting to the point, like I said, where I'm not going to really be talking about my portfolio as much. I might start building out maybe a YouTube portfolio where we can just be a little bit more engaged from the individual stock side. But for where I want to be in my goals, I'm knocking on that door very closely right now. We paid off over 80% of our mortgage. Our portfolio is, between the wife and I, are getting in line with where we want to be in the next 1 to 2 years. So kind of when that gets ever closer to finishing up what my short-term goals are with this, after putting a decade of time into this, I will basically just be, hey, I've made it to where I need to be. I'm happy with this. I'm not like I'm retiring or quitting working, but it's just, there's no entertainment in YouTube talking about ETFs, guys. There's no fun in this. And I'm going to have to find a way to navigate it, because I've transitioned from individual stocks and capitalizing on a lot of good growth over the last decade and one of the greatest bull runs in human history, to transitioning those gains into long-term foundational, what I like to call wealth preservation funds, where I sleep much easier at night. We started out with 5-10 grand in 2 individual stocks, to now this broad-based portfolio, real estate, finding a relationship that's, in line with my financial goals. We were just joking in the chat group that the biggest financial decision you'll ever make is who you date, who you marry. I mean, that'll be the defining factor to a lot. But yeah, we're in an interesting phase right now. I'm sure with a lot of you too. Jason, we've seen come up a lot. I mean, there's so many guys in our chat group too that we started 4 years ago, and we all were in much different situations 4 years ago. So I'm very happy to see the community doing as successful as a whole. Shout out from Brampton, Ontario. Nice to see you guys coming all the way up from Brampton. You're not too far from me though. Brampton's, stone throw away, less than an hour drive. The only YouTube channel I look forward to watching. Oh, thanks so much, brother. I appreciate that. So a lot of YouTube channels. We'll discuss that shortly. I hope you guys, maybe we'll brief on it real quick, but are any of you guys going to the Blossom event? I'm usually not the most community involved person out there. We got another guy from Kingston. I'm very kind of sheltered. I like just working at my job, keeping my head down. I don't do a lot of communal events. I do very little outings to meet you guys. Once in a blue moon, it might happen. But I've been debating this, because I was shocked that they were only charging $58 for it. Because I think that comes with drinks, food, a bunch of other. I was pretty shocked. It's a whole day event at the Rogers Center. And I'm Toronto, your Rogers Center's not far. I could just take the subway down on September 21st. I think it'd be interesting. I think it'd be really interesting to go to an event like this. Maybe it'd be something that we can use as a meeting for you guys and kind of support the community as well. But yeah, I'd love to know if any of you guys are actually going to this. But otherwise, maybe we'll answer a few of your Q&As over the week here. You guys had a lot of interesting questions around my Canadian dividend stocks. You guys had a lot of, ideas too. And what I like to see the most, again, I always like the idea of taking profit, baby, when you're doing well, but sold a third of my shares of Celestica and made $1 grand in profit, threw it into VDY, XQT, VFV. I've been at this for a year and trimmed down some of my stocks and threw them into ETFs. Nothing wrong with that. Like I said, I'm not trying to fear you guys out of your individual holdings either. I'm just I recognize something that I know is a detriment to a lot of investors. They look at paper gains. They're I'm up 500. I know people that are up 500+% on stocks. Those stocks have ballooned into some of the largest positions in their portfolio, some making up half of their entire investments. And I just don't think they understand the risk that is associated with that, because they kind of get, a bias that their company is safe. They understand it, but they just don't understand how quickly at the flick of a switch, those gains can get evaporated. And just, I become so successful in where I'm at just because I recognize profit and actualized it and continue to expand on my portfolio over time. So I just don't want to see anyone get in a situation where they're a Palantir, or they're up a huge god awful amount of money, but they're just not trimming it because they believe in it long term. But then you end up in a Tesla situation, right, where 5-10 years from now, there's no gains to be made at all. And I've made mistakes too, even taking profits from Tesla and putting it into investments that might not have been appropriate at the time, like SCHD. I didn't need the dividends from SCHD. Why did I buy it and hold on to it for 4 years? Because I made virtually no gains over those 4 years. It was a complete waste of time. But, you learn as you go. I'm not perfect by any metric either, right? But yeah, thoughts on investing a safe amount of VDY in margin accounts. The idea that Dividend covers the margin interest, wealth, simple, decent rate, or at least keep it from compounding. Then once I decided to sell long term, the capital appreciation is just a gain. I keep, gains I get to keep from other people's money. So this is a whole different concept that a lot of people get comfortable with real estate. This is I have zero risk tolerance. There's one time in my entire life I used a line of credit to buy stocks, and it was during the pandemic, and that's because I lost my job. I was obviously taking on a lot of risk doing so, but I just recognized that this pandemic is a short-lived experience and the stock market was no reason to be trading at the levels it was. And obviously that was a very calculated and gave me a good rate of return. But the reality sits in, there's what was the video? There was a guy, and he was on, what podcast was he on? Oh my God, this dude was buying option ETFs and leveraging them through margin and using the income, the distributions from those option ETFs to basically pay down the debt. And he just figured by the time the debt gets paid down, he'll own the equity that he could sell off or do whatever with. And he mentioned something, that he has an incredible high level of risk tolerance that I just do not have. There's guys like Dumb Money out there, like Chris Camillo, who like does crazy leverage plays into wildly risky investments where he gets margin calls all the time. I think if you go on his Twitter or X right now, I should pull it up. You'll see that he's showing like a good way to ruin a weekend is he's just constantly getting dings that he's getting a margin call and he needs to add equity to the account or cash. And I'm just like, I couldn't do it, man. I'd be better off not paying this mortgage off and just keeping it in the markets. I mean, why did I pay it down so aggressively? I just can't do it. I don't know how you guys live your lives. I was 20 grand in debt once and it took so long to pay it off. And I can't do it again. I just live and sleep knowing that I'm not working for somebody else. Cause like Dave Ramsey says, like, the debtor is slave to the lender. So, I mean, like if you take money from somebody else, like you're just working for them. At the end of the day, right, if the markets do materially go into a black swan event, you got to ask yourself, are you prepared for a 40% downturn? I would keep stressing that in market environments like this a lot too, because I've never really lived through it with the exception of the pandemic. 2022 is pretty, pretty visceral for those that were in crypto SPACs. A lot of individual stocks. You see the ones recovering. There's another 1,000 that didn't during that period. 2022 was vicious, right? So I look at that and I don't want the bank knocking on my door. I hate the bank making interest off me. I'd rather be my own bank. I want to be like a sovereign wealth fund. I want to be like, what is it, Switzerland or whatever, where like I am sufficiently loaded and I am my own bank. I want to start buying gold. I can decentralize with crypto, but ain't no bank going to have leverage over that. That's just me. If you think you can stomach it and get a lower rate and you think you're going to get ahead with it, go for it. But just understand, market downturns will come in your lifetime and they can be ferocious, man. And it just reminds me of 2008. Everyone's like, oh, real estate's the safest thing in the world. Till you understand too, like when you sign up for a mortgage, at any point in time, the bank can call that loan. I don't think people understand that risk. Like when you sign on a $1 million mortgage here in Canada, at any point, the bank can knock on your door and say, we want the rest of our money back. So, I mean, you got to be prepared. Like, not that that's going to happen, obviously. I mean, those are extreme circumstances, but that is what you're signing up to. And it is a risk, which is, again, like most people don't even look into half the stuff they're signing when they're getting mortgages or doing margins. And they don't there's just so much more risk than I think people understand or associate with it. But if you can handle it, there's people that do well with it. I just don't. Off topic a bit, Kyle, but I wanted your thoughts on a reduction in the VDY dividend this month. Yeah, so I don't know if this has to do with maybe just the valuations and stocks moving around. Obviously, there's a lot of volatility in a monthly paying ETF. We saw the reduction again, I think, in BCE's dividend. Bell keeps cutting their dividend. I mean, Bell has been getting destroyed. So all these stocks are weighted in this ETF by their market cap, right? So if we see things like Royal Bank and all these stocks starting to continue to rally against some of the other, mega caps, and they have smaller dividends, we could see a reduction in dividends over time. I presume over the long run with dividend increases, this will materially go up, but that's what you get with a market cap weighted ETF. It's one of the reasons I also like VDY, because the total returns are exceptional. I think they're great for a monthly paying dividend ETF. And again, I'm a total return oriented investor at the end of the day. So I don't care as much if the dividends go up, so long as the total returns continue to appeal to me, because I don't mind selling stock if I need cash. It's not the end of the world to me. I just like having a bit of income and I like Canadian exposure. And again, I chose VDY for quite a few specific reasons. ChatGPT tells me I should consider diversifying outside of Canada and the US with an ETF ex North America. I agree. ChatGPT and is actually becoming quite a resilient. Same with Gemini. These language models are actually really good at financial advice. Surprisingly, that's what I'm starting to do. But personally, like I said, I I don't mind being concentrated right now because I am so young. Like I'm think I'm doing this in a very calculated way. I'm still very diversified. I think the ETFs I own give me a crazy amount of diversification from where I was. But at the end of the day, like global market ETFs are like the bread and butter, the benchmark of like safety and security. Because I mean, you look out through history, right? There was a time not that long ago where the United Kingdom was like the leading dominant country, currency, and all that. And when you look at China right now, man, I know China doesn't get much of a bid, and their stocks trade at relative cheap values because people just aren't comfortable investing there for some reason. But man, China's economy is on fire. Everything that we're doing, they're doing better in every aspect. I mean, I don't know how, like, look at BDY as an example, right? Or BYD, not, BYD, this is what I kept saying about like Tesla. And I don't know how Tesla shareholders just aren't depressed that like, Tesla started the EV revolution. And here we have a Chinese company that just kind of came up late now, crushing, trading at a way cheaper multiple. It's doing almost 3x the shipments that Tesla's doing. I mean, they're doing 1 million a quarter against Tesla's 380, 400 or whatever it's at right now. I mean, I'm just always blown away. Like, look at their energy sector. Their energy sector with renewables is on fire. Your nuclear power plants are they have the biggest country with the highest level of to come on, like, to basically build out nuclear power plants. Like, they have all the infrastructure. I'd be curious to how they're dealing with AI and data centers. That's another thing that I'm marveled by right now. And like, I'm just shocked. Like, I don't think people understand the scope or the scale of what, these companies are trying to do right now. Like, this is Meta's dream in the future. Like, they want to build a data center that is basically the size of Manhattan. Like, I mean, what's going on right now with these data centers is nothing short of a marvel. Like, I don't even know what to compare it to. Like, it's probably going to be the biggest Canadian. It's the biggest human projects like ever constructed ever. Like, they're crazy. These are going to be $1 trillion investments over 10 or 20 years at the end of the day between all these companies, right? So I'm curious to see how China's combating this and dealing with this kind of infrastructure. But this is what's coming, man. And that's why I kept saying, like, NVIDIA's got a runway here, and I don't know what chip innovation looks like, but I know whoever owns these data centers, whoo, baby. And whoever makes the software and gets a monopoly on it, which there's only going to be a few companies. I mean, how many companies can actually play at this scale, right? Like, none of them have the capital except for Google, Meta, Amazon. I feel bad for Apple. I think, I was having some like epiphanies the other day, my stock market epiphanies, and I was just feeling so bad for Apple because I'm like, for the first time ever, like, I've been debating on switching out my Apple Watch. It's hard to get out of the ecosystem, but I'm like, Google's introducing their Gemini to the Google Watches and all that stuff. And I can't figure out why Apple wants me to pay to upgrade my phone to get a better Siri when I'm like, I just downloaded the Gemini app and I use that as Siri. I just hate that I can't play my music or operate across my apps. But I'm like, why would Apple charge me to use a better Siri? Why isn't Apple just integrating into all their software, all their watches, all their phones, an app that is the equivalent of Gemini, or integrating with one of these companies more? I imagine they're working on it, but it just bothers me. They're so far behind because they have all the potential to actualize and steal so much market share, yet they're so far behind the game. I just can't figure it out. I'm like, they have the device everyone's using. Make it useful, because everyone is using third-party apps, nothing that's like proprietary from the Apple device. Google, I mean, like, it's almost worth changing over the Google phone now, Pixel or whatever, because they're actually integrating this insane software and the value of these crazy huge, cloud centers and these AI data centers and all this stuff. So Apple made an AI assistant 10 years ago, and yet it's the worst one. I know, it's like, I feel like Steve Jobs would be rolling around in his grave. Like, Apple was on the forefront of all of this stuff, and now they're just like, let's just wait and see. And you want to know how scared Apple is about this stuff? They're scared because when Meta got so far ahead on the VR stuff here, Apple's like, well, we can't have people using other devices, right? So let's just go all in on this. And even if we're wrong, who cares? We'll have the superior product that people are going to want to buy. And I just don't know how in the AI race they're going to win that. If OpenAI, working with that Apple engineer guy, on whatever product they're working on. If these things materialize, like it's the first time ever that I see market share being taken away from Apple in new devices. Because I mean, these new phones are getting way more technologically advanced than Apple is with like the cameras and zoom. I mean, all the AI integrations, like what is going on with Apple? Why are they lagging so far behind this stuff? It's it's horrible. Apple's acting like BlackBerry and BlackBerry is on top. Yeah, I don't think they're going anywhere. I'm not saying it's the end of Apple, like BlackBerry had their moment, but I just feel like with what's going to come down the road in the next year or two, if Apple doesn't integrate any of this into the phone in a material way to stop users from leaving, users are going to start adopting. And yeah, I mean, Apple for the first time ever will start losing market share to new devices. I don't know how they don't. I've never been pissed off. I've always been an Apple fanboy. I've got a MacBook. I love the MacBook still, the M1, all that stuff, great. But when it comes to phones, watches, and all those other products, man, if they don't get on the ball here very soon, I just don't see how they keep the leg up. But anyways, congrats, Kyle. Just started my TFSA this year, and I'm curious on your thoughts with the crypto ETFs you like. I don't like crypto in general, and I like what it's meant for, which is decentralization, like gold and banking in general. So I'd rather own it through, obviously wallets, like your own wallet, rather than on an actual centralized system. But if you're going to own it that way, there's only one way to really own it, and I would recommend maybe doing it through iBit or some of the BlackRock ETFs. And the reason I recommend these is because they have the lowest fee structures of any of them out there. They're not trying to leverage like crazy, like your micro strategies are. It's just, I think it's the cleanest way of getting exposure to crypto in your tax-free savings account, and maybe mix a bit of ETH in here as well. I don't know if you want to go all in on the Bitcoin side of it. I don't do this in my TFSA because I just don't trust it right now. And Bitcoin hasn't been around long enough. I would trade it. I like trading it. I own a little bit of it. Like I said, the wife and I do have some long-term crypto outside of our portfolios, but it's just there as speculation. I don't look at it as anything more than a pure speculative play, because I just want to see if we go into a true downturn like a 2008 or a dot-com bubble, how does Bitcoin hold up? Because right now I think it's one of the biggest bubbles in the market. And I've said this time and time again, you can't tell me the difference between Bitcoin and a Ponzi scheme. Everyone is just buying it based off what? What are they buying it off of? Say it with me now. Past performance. Does past performance equal future return on a company or an asset that doesn't produce anything? Is it just a trading card? Don't tell me it's a decentralized currency. Then why are you buying it through a BlackRock in your TFSA? That doesn't make sense at all. Like, there's nothing about it that makes sense to me. So I'm not going to like load the boat on it. I'm not one of these religious, I have to cost average into it every month with my paycheck. I own it. I get it. But let's see what happens. Before I go balls to the wall, let's see what happens. I got some exposure. If it works out, great. I made some money on it. In the meantime, I'm much happier owning Google stock. HMAX, it's junk, declining dividends since inception, yet banks have increased the dividend. So my mother and I, HMAX, you guys like your option ETFs? What a great conversation my mother and I had over the weekend. She's really into the idea because she's talking to her friends, and her friends are like, oh, we're making 10, 12% dividends off our portfolios. And I said, are they though? That is the question. Are they though? Because I mean, these option ETFs are they're a little bit of an illusion when it comes to total returns, and I don't like looking at total dividends as the actual rate of return. But my mom calls it boomer candy. She said all my friends in these articles she's reading refer to option ETFs as boomer candy because they don't care about anything other than cash flow. And I talked about HMAX being one of my more favored Canadian option ETFs. And I say this because it's still fairly new, but I like the financial space in Canada. The 13% dividend it offers, a complete fallacy, doesn't exist because the total rate of return since inception has been 11.2%. Don't get me wrong. An 11.2% return is incredible, which is why I like this ETF, because the underlying performance is there. And I do like, the exposure that it's writing the covered calls against. But the caveat here, and I said this, I think, on my last stream, if you look at the 1-year return, let's use the 1 year as an example. The rate of return has been 26.47%. Okay. So you're like, damn, that's fabulous for an option ETF. But again, if you look at the underlying assets and look at a pure play without writing options against it. So let's use ZEB as an example here, the BMO equal weight bank ETF. And we just look at the performance of this as an example. You can see that the 1 year return has actually been 37%. So you've actually left a 10% rate of return on the table because you thought you wanted income. And at the end of the day, I'm a guy that doesn't mind selling shares. So, I mean, in the last year, you could have sold this and I would be up 10% more than you. Like, you know how crazy that is? So this is what I keep trying to tell my mom. I don't care that you want to own these. I don't think there's anything wrong with owning option ETFs. I just don't want to see your entire portfolio in option ETFs because it's a fallacy to think that you're getting ahead in any material way. And again, even though you're in retirement, I'm like, you're not dying tomorrow. You're going to be around for like probably another 20 years or longer. So I'm like, why give up so much rate of return when you don't have a problem taking profit? You have enough dividends, very safe investments. You're getting your 4.5%, 5% yield. Your portfolio equity is growing on top of that, outpacing what you'd be getting from these option ETFs. So why worry about it? If you got your bills covered, don't worry about it. If you want to speculate, yeah, go take some stock and maybe put 5, 10, 15% of your portfolio in these. And we do. Like my mom owns some of these. I just said, don't get crazy. Just don't think that this is like an end all be all solution to investing because it's not. But there's nothing wrong with them. They're just not going to perform as well as the underlying assets. I'm a new investor and I bought SCHD. I recently learned about the dividend taxes Canadians get for owning a U.S. dividend stock. Can you please explain this more? There's not much to it, to be real. Don't overthink it. Just be really careful owning U.S. stocks outside of a tax-advantaged account. I don't think there's anything wrong with paying a 15% withholding tax on U.S. dividends, even in a TFSA. You don't pay it in an RSP, but who cares? 15% to get tax-free income thereafter, who cares? That's nothing, right? Like, it's a pretty low income tax rate. And the only thing I can recommend if you want to learn more about tax rates is go to Wealth Simple and look at their tax calculator, because this is like, I know some really, really intelligent CPAs out there, and they all tell me just go to this Wealth Simple calculator, look up your province, and just play around with it. Because I told you guys, like even outside of a TFSA or an RSP, if you were to make eligible dividends, you could make $50,000 in eligible dividends and pay no tax. You pay $600. So it's just like, you know, if you're going to own dividend stocks in the Canadian side of it and they're eligible, like, is it a big deal to own it in your TFSA? No. So maybe you're better off taking on a little bit more risk with your TFSA and looking at things that are ineligible, like U.S. dividends, perhaps. Because if they're ineligible dividends, even on $50,000, you're only going to pay $2,000. Like, it's still pretty immaterial, but you want to understand the taxes and like actually fully taking advantage of tax advantage accounts. Just holding Canadian dividend stocks, yeah, you're going to still get some tax advantages, but for the most part, it's not that crazy. And you can say the same with capital gains. Like, you made 50K in capital gains, you're still only going to pay $2,000 outside of like, you know, regular accounts. It's kind of crazy how little, you know, investments are taxed in this country, but yeah, it's pretty wild. I do agree with extreme greed what's going on in the market, but I'm curious if that applies to all companies. Suncor, C&Q, Resources, Fortis, Enbridge, you know, Philip Morris, TELUS. I think to some extent, you know, there's variables. I get that you like the ETFs and you're kind of just looking at, this is the same thing I'm doing. Like, I don't think all individual stocks are trading at extreme values right now, but the vast majority of the market is. I think most of that is driven by tech. You know, it's driven by tech. You look at the valuations on Palantir and NVIDIA, and like these companies have to continue to justify those values long into the future to actually like give you any real rate of return. Tesla. In the Canadian market, Shopify is kind of getting pretty expensive again, Constellation. So no, like this is why I buy things like Google and I try and play that game, right? Which is what I think you're trying to do here. And at the end of the day, like I am a value investor. Like I get it. Like I don't mind paying an extreme value if I can recognize that there's future potential, but I need to understand that future potential and I need to know that it's coming in a low risk way. It's kind of like again, a good example of this is like the cannabis market back in 2018. It's like you knew legalization was coming. You just had to buy those stocks. There was cannabis stocks long before legalization came around. So just buy the biggest one. That's what we did, Canopy Growth Corp, right? Like it wasn't rocket science to realize what was coming. If you looked at those stocks, though, you just said they're expensive, they're small caps, they're too risky. But it was like, they're going to legalize it though. So like, you can't just judge the value of the company today knowing that that was coming, right? So, you know, when I look at things like some of those stocks, I don't understand the future value of it. So I think in general, they're bubbles. And I think most people couldn't explain to me the future value. Like, again, I just, maybe I'm an idiot. I always go back to Palantir, right? Because I'm like, I just don't get this business model. They're growing at a 40% clip, but at a 670 times multiple at a $362 billion valuation. I just can't get it. I'm just like, it's the same thing with like Tesla, right? I'm like, where's Tesla actualized value? Like, forget robotics. The company isn't making any money off what they're doing now. And they're trading at almost a 200 times multiple. Like, in what world 10 years ago could you imagine a $1 trillion company trading at a 200 times multiple? I just want you to understand that the PE is a representation of the current earnings and how many years it will take of just the underlying earnings to get a full rate of return. Tesla today, with the businesses they're operating, will take 200 years almost to actualize a full rate of return. And they are not growing. I just don't get it. I just don't. Like, don't give me this bullshit about robotics. We don't even know what that business model looks like. There is no business model for that yet. I thought there was a huge business model for self-driving, and that's taking forever. Hey, Kyle, you're killing it, dude. I sold all my assets in the markets for income property. I guess I should have left it in, lol. Would have been much further ahead. What's your thoughts on income properties? Any tips on dealing with the feeling of regret of moving my money from the markets to real estate? If you love real estate, it's fine. I know the real estate market hasn't boomed yet, and the markets are booming, but I'm speculating that this is like the down period of the real estate market. And if you want to buy real estate, there is no better time than now. That is why we bought real estate. I'm not looking to make a rate of return off my home. I mean, I don't look at it as an investment. Yes, it's an asset, but I don't look at it for a rate of return. But you're somebody that's clearly buying real estate for a rate of return, renting it out. Hopefully you're diligent. Maybe you understand it much better than I do. You can't, like I said, I'm a guy that wants diversity. So for me, I don't like the risk tolerance. I would have never done that. As I told you guys, like, we keep a 50-50 split. So like, the real estate value we have is the same value we have in the stock market. And if our stock market value goes well beyond the real estate value, then we start paying off the mortgage faster. And we just try and keep them at parity until the mortgage is paid off. So we have the same mortgage value that we do in the stock market. So we're like a 50-50 split. It gives me a little bit more comfort. Then from there, hopefully the portfolio well exceeds that. But personally, it's your risk tolerance, man. With interest rates, I don't know what your average interest rates are. I couldn't do it. I'm not like a Ben Malla. I'm not like Grant Cardone. I can't do it. Like I said, I hate debt. I'm fundamentally a little bit more like a Dave Ramsey guy, where if I'm buying real estate, I'd rather buy it with cash because I don't like leverage. Again, I couldn't have a $10 million real estate portfolio and only having like 2 million of equity, like 20 or 30% equity and just cash flowing it. I mean, you saw what Ben Malla goes through. If you don't watch Ben Malla, go check his channel out. I'll give you he's like an incredible example of like the stress that can come with real estate, because man, that guy, I couldn't get over his channel, and I loved watching it during that like the boom and bust of real estate.
Tonight, you're buying her Ferrari.
He lives at large though, man, but like the stress that comes with that. But it's a family business for them, right? So like, they love it. Their family's involved with it. He's smart. He understands the leverage. He gets all of that. Real estate is a full-time job, or at least a part-time job. And I'm far too passive to want to deal with it. And I just think people think it's a passive game, and it's not. So, I mean, if you love real estate, it's a passion, look at it as a job, then you're great. But if you think you're buying it as like an investment vehicle for like infinite returns, and it's not a job and it's passive, like, you're probably a bit delusional about the actual reality of dealing with tenants, fixing properties up. You can't really go on vacation. Like, if you don't have a property manager, you can't go on vacation. Someone calls you and a toilet's broken. Like, that's your responsibility to fix it, right? And I can't deal with it. And most people I know that are in retirement sell off most of their real estate because they just want it to be more passive. But yeah, I mean, is what it is. What do we got going on here? You couldn't stomach to hold till May of next year. Needed the money that bad, eh? This is in reference to me selling Take-Two. People always get mad when I sell stocks that I'm hyper. I am still loving Take-Two Interactive. I'm not like against the stock because I sold it. I just don't want the risk. I just don't think people understand, like, what am I going to do? Do I want to hold 5 stocks and level them out to being like 15 to 20% of our portfolio? I don't want to be that guy. I'm not that kind of investor anymore. I don't want 5 or 10 stocks. I just want to own 2 or 3, and I want to make bigger bets on them because I'm more confident they're going to work out. And as they work out, I'll take profit. But I had so much money in these stocks, man. I was sitting on, like, between the wife and I, like, 150K almost, 200K. Like, we had a lot of money in these stocks. Like, we were throwing 50K at this one, 50K at that one. And I'm like, look, if I had to pick 1 or 2, what are they going to be? And it's going to be Google. It's going to be Meta. and I've got some small cap risk. I've got Aduro, I've got crypto, I've got all this other stuff that I'm like, look, I just don't need another mega cap. And if I cut the position in half, who cares if it goes up 50%? If it goes up 50%, I've only got 15 or 20 grand in it. Who cares? It's nothing. I've got 50 grand in Google. If that goes up 25 or 50%, like I'm going to make a material return, and I'm just more confident in the short term for Google if the market downturns than I am Take Two. Take Two is just, if we go into a massive market downturn, I just think Google already has priced in so much of the risk and haven't priced in any of the upside, whereas Take Two is the exact opposite. Take Two has priced in a lot of the upside already, and it hasn't changed in revenue. Like there's no revenue growth off what they're doing. It's flat, right? So I'm taking on a lot of risk waiting till May. And if we get a black swan, something bad happens, this could crash materially very quickly, right? So I'm just adjusting the risk of my portfolio. If you like Take Two and you want that risk and it's one of your favorite stocks, you like the video game sector, go for it. But I'm just saying, like, you know, I flip-flop over time. I held Take Two for 6 months. I made a good 14% gain on it. I mean, I outperformed the market with it. So like, you know, why take on so much risk if I don't think it's necessary? Do you think Apple is sleeping monster? I think, as usual, Apple, you got to go back, go back. It'll buy out the best AI firms in the market. So here's the problem. Go back and watch our Apple conversation. We just talked about this. Apple can't be late to this game. It already is too late to the game. If Apple's this late, people have already moved on. So look at Gemini. Like the risk with Google is ChatGPT is the #1 downloaded app. So even if Google has the best AI model out there, people don't care because they're already using ChatGPT. So, you know, that's the problem Apple's going to have. Like people are going to start switching devices and it's hard to get them to switch back. That's what I said. Like, I'm like, why can't I use a better version of Siri? Why do I have to upgrade my phone to get a better version of Siri? I'm using Gemini or ChatGPT as an app. Apple should already be upgrading. Like, you know, Google's introducing AI devices on the watches now. Apple's not. It's a disaster. But let's just go take a look right now and see what the most downloaded apps are. Because it's hard. Once you get that market share, it's very hard to take it back because people just get stuck in their ways. But I'm just curious. Let's go to the App Store real quick because I'm like, this is another reason that I'm really bullish about like Meta. Not only because they're building these massive AI data centers, but man, look at the most downloaded apps. Let's see what they are right now. I love using this as an indicator to like who's buying what and where the market attention is. So the top free apps right now continue to be these four. These are the top five. We'll just look at the top five. So you've got ChatGPT is still #1. Timo is #2. Timo is crushing it. Like the whole Labubu thing. I wish, I'm sure Timo wish they were on top of that. Man, what's the company? Pop Mart? Pop Mart's the one that owns the Labubu brand. They're crushing it, man. What a crazy trend. Then look, you've got Threads. How is Threads one of the most downloaded apps? Mark Zuckerberg is maniacal. I think Threads is going to be one of the, like, that's already like probably a big enough friggin' company to be an S&P top 500, right? I can't get over they have like almost 400 million users already. It's crazy that it's one of the top 3 most downloaded apps. Then we got Google, luckily still in #4 there. And then you got Uber. I mean, you could build an investment thesis just off this because this is where the attention is, and the attention is money. So like, this is why Meta and Google are our 2 largest positions, because you can just see the growth and the under-recognized value in many of the upsides. I mean, Meta's finally monetizing WhatsApp, the most utilized messaging app in the world that has never been monetized yet. And then we have Threads. Threads just came out of nowhere, and it's already over half. It's just above half the size of what of X. It's like already competing with X at almost their level. Like it's mind-boggling. Oh man, yeah, we live. I mean, I don't know. I'm obviously taking on risk here. I mean, there's a lot of risk with these stocks, regardless. But I sleep so easy at night. I just love Google. I love Meta. I understand. I use their businesses on the back and front end. I work for them. I love them. I will marry them and put them in my portfolio, and I'll scale them down to probably about a 10% weighting, 5% each eventually. But for right now, I just want that little oomph to see if it works out in the next year, and then I'll sell them down, keep the rest long, and live my legacy portfolio into the future. What else we got going on? I own both Apple and Google, but it's the same with everything for Apple, screen display or anything. They were late, but they went with the best. Yeah, but they could be late on that stuff, right? Like the innovations in phones, people don't really care about having like the zoom being that extreme or like what the screen is, whatever. Like Apple, again, it's the ecosystem that they built in. But again, materially, if I'm like, just ask yourself, do you use these AI models at all? Are you using ChatGPT or Gemini on the daily? Because we do. Like we're using them all. We just went for a walk and we were using Gemini video to ask about plants and flowers and just things that we didn't know. Why is Apple not integrated that into the camera already? Why is Apple not integrated any of that into Siri? You know, like if Google comes out with a Pixel and the phone is already the equivalent or better than Apple, but I get all that upside with AI, I am already, as an Apple user, inclined to leave. And I'm sure many people out there are questioning the very same thing, seeing Google market their Gemini on watch devices. Like we're literally looking at Jarvis from Iron Man is as a real thing now. Jarvis exists and it doesn't exist in your Apple device. So I'm like, you know, it's horrifying. And I don't know, is Apple even building data centers? Like, let's look it up. Is Apple even doing any of that? Apple AI centers investing. Are they investing in any of this stuff? Apple announces 500 billion US investment. How much is this going toward? Like, is this for the phones? So I think that's backdating to when they were dealing with Trump, trying to get them. Apple is investing 500 billion to US based AI data centers and AI servers. Let's take a look at this. Because this is my concern, right? Like, how are they utilizing this and why aren't they doing it now? So this is going to be over the next 4 years. GateStar project, Applegate, iGate. So if they're doing this, then like I'm just so confused. Why don't we see any of this materializing? It's pretty likely that the entire surface of the earth will be covered with solar panels and data centers. Yeah, that's what's coming right now, isn't it? Yeah, I don't know. I guess we just got to be patient and find out. But hopefully Apple brings it around. What do you think about ARK? Yeah, I'm kind of perplexed. I'm really shocked that ARK hasn't performed as well. Because now that we're back in a speculative market, I mean, okay, well, it's starting to seem to have quite a comeback there. It's up almost 100%, but they're just starting to come back, right? Like I'm shocked that it's taken them this long to recover because they did hold. I don't know if it's just their trading method or what, but we are back in a very bullish speculative market, and these are the markets that ARK shines in. So who knows? Maybe this is the final turnaround story where ARK kind of picks it back up because man, Kathy has been beaten into the ground. What are they holding ARK these days? Let's take a quick look here. We got Tesla still at 10%. Coins in here, Roblox, Roku, Circle, CRISPR's still great. Robinhood's in here, Shopify's in here, Palantir's. Yeah, this is still a pretty good ETF. But again, like these are the stocks that I actually try and avoid. Unironically, I don't like Hood is getting very expensive. Shopify. I mean, Hood is like the gamification, and it's such a like an example of like when the markets get speculative because Hood is just introducing like the most gambly stuff and they just try and persuade you to trade as much as possible. And it's not even like the best like the best investment app out there. Like I know a lot of people that don't like it because it's just not as integrated as some of the other trading apps, but same with Shopify. Like Shopify is super expensive right now. Palantir, I can't even justify or understand its value. So, I mean, CRISPR I like, but again, it's got a long ways to go still. And I mean, even CRISPR's competing with Google right now. Because Google's advancing pretty rapidly on into human trials with some of their AI built out drug formulas. Yeah, I don't know. I don't think I'd be in this today, but if you like risk and you think we're going back into a speculative market and you think it's going to last for a little bit, I mean, man, this is probably a good time to own ARK. They do own a lot of the more riskier, higher flying stocks. So, yeah. But anyways, folks, what else is going on? We're going to finish up here quick. VDY for non-North American ETF or VDI. XQT. I mean, if you want, there's good global market dividend ETFs, but I still like XQT a lot. There's a lot of good ones though. I mean, you could pick, what is it? VTI. There's so many global market ETFs. Just pick your favorite, whatever works for you. If you want US or Canadian dollars, they're all there. You don't have to do a lot of research to find them either. Thoughts on FLT.V? What is that? FLT.V? FLT.V. Let's take a look. Valetus Aerospace. Oh, you're back into the aerospace. Hey, we were just talking about this last week with another one of these aerospace companies. They're doing very well right now, and some of them are actually very profitable. with the onslaught of Rocket Labs, there's so many out there I didn't even hear of. But yeah, that's a conversation for another day. Boomer Candy, yeah, those option ETFs, man, Boomer Candy. Mark Carney has over 500 stocks in his portfolio. Yeah, we were talking about that last week. A lot of people think it's ETFs, but I'm pretty sure they stated that it was individual stocks that he has some manager, dealing with. And I can't imagine the fees that guy's paying to manage 500 stocks. Anyways, guys, there's a lot going on here, but I do appreciate you all stopping in. So let's get ready for next week. I can't wait for Google earnings. Tesla's earnings are coming out. We know those are going to be a garbage regardless with the delivery numbers that were put out, but I'm sure investors don't care. But yeah, it'll be fun nonetheless, man. In the speculative market, the portfolio continues to hit all-time highs every day. Doesn't make me excited to keep cost averaging, but we're all loving it, right? Regardless. So we'll see how much higher we can go before these chickens kind of take a break and come to roost, because I think Netflix is kind of a canary in the coal mine, perhaps, to overvaluations. I mean, Netflix corrected on great numbers. But again, when you're trading at 50 times multiples, man, even with great numbers, it's hard to get up there sometimes. So stay cool, stay diligent. And as always, I look forward to catching you in the next one.